My name is Michael Guyad, publisher of the Lead Lag Report at Puzder. Andy, for those who are not familiar with your background, introduce yourself. Who are you? What have you done throughout your career, and what are you doing now?
Well, I originally was an attorney, and I went to Washington University in St. Louis. I went on to be CEO of CKE Restaurants, which many of your listeners may know as Carl's Jr. and Hardee's. I ran that company for 17 years, and then I went on, I've written a couple of books, Job Creation, How It Really Works and Why Government Can't Understand It. And the second one is called The Capitalist Comeback. I write on the Wall Street Journal regularly, Real Clear Politics, National Review. I also do a lot of TV, CNBC and Fox News. And I was nominated by President Trump to be Secretary of Labor. That didn't go through, but it was an honor to be nominated. And now I'm a visiting fellow at the Heritage Foundation and a senior fellow at Pepperdine University and the America First lobbyist. So that's kind of me. America First Policy Institute, I should say.
How has the restaurant industry changed from your time with CKE to today?
I think what you can do advertising wise has changed a lot. Things you could have done that were kind of fun to do, and back in the early 2000s have since become politically prohibited, so it's difficult to do them. The kind of things that were people considered funny 20 years ago are now no longer considered funny, but politically offensive. And the labor market has changed substantially. We've now post pandemic have different attitudes about work, about the importance of work, about the need to work, about the diligence you're expected to provide at a job. And prices have soared. We've seen inflation really impact the price of food, housing, labor. Everything's gone up. So it's become a lot more difficult to run a business than it was when I did it. I retired in 2017, and even that short a time ago, it was much easier to run a business.
All right, let's hit on this point about the attitudes changing in terms of labor force. A lot of people obviously point towards COVID and stimulus and handouts and sort of a cultural shift among younger generation that maybe got used to having the government give them stimulus. But I have to imagine that the roots probably are a little bit deeper than just post COVID. What do you attribute some of these changes in terms of how people perceive work, and how does that play into different age groups?
Well, I think really a lot of the change was during COVID. I talk to people that are in the restaurant sector now, particularly franchisees. People that own between one and maybe 100 restaurants, and they noticed a distinct difference in the way people, particularly young people, approached work pre-pandemic and post-pandemic. And I think a lot of that has to do with incentives. People during the pandemic were able to survive off of government benefits. Many young people stayed home with their parents because you really couldn't go out. There really weren't a lot of jobs. So I think for about a 2 year period, maybe a little more than 2 years, 2.5, you really had a shift in the way people viewed work there. And coming out of the pandemic, there have been a tremendous number of jobs, and really not enough people to fill the jobs that we have open. There are about 6 million people unemployed and about 11 million job openings. So you've got a situation where employees are competing for employees, and when employers compete for employees, employees have a lot more influence on the conditions under which they work. So you're hearing, and really, if you think about it, let's take these age groups. People that were 16 or 17 when the pandemic started, they're probably between 18 and 20 now. So you're finding a whole group of young Americans that have been raised in a time much, much different than the time I was raised in, or probably the time you were raised in, where it was important that you get out and work, where people actually were incentivized not to work. And as my friend Art Laffer always says, incentives matter. You incentivize people not to work, they won't work, and when they come back, they're going to have different attitudes about work. So I think that's what I'm hearing from the people in the restaurant sector right now. That's what they're facing, and that's what they believe caused the difficulties. I think that will dissipate as government benefits run out, and when people that are living with their parents, when the parents start to say, son or daughter, it's time to get a job. I think we're going to see a change in the workforce, maybe back towards what it was prior to the pandemic. But we'll see. If if the Democrats retain control of the House, which looks unlikely, and the Senate, we could see a continuation of the government spending, the government benefits, which would, of course, have a negative impact on the workforce.
So the natural response to improving incentives, presumably, is just to pay more, right? I mean, you can incentivize somebody to work if you're giving them a larger salary. It sounds to me like you think that it's deeper than that. That it's more than just a question of dollars.
Yeah, it's salary dollars, hourly pay has been going up very, very significantly over the past year. We're talking about increases of 5 to 6%. I think last month was the first month that went below 5%. This year it went to 4.7%. The and what I'm hearing from people in the private sector is that it isn't really pay that's the problem. They're willing to pay up for workers and are paying up for workers, but they still get comments like, "Well, I don't want to work weekends, or I don't want to work Friday night, or 35 hours a week. Gosh, that seems like a lot." And you've got people moving from job to job, which means you have to train new people, which is an expense. So there's a lot more to it than simply dollars at this point. But as I said, I think as the government benefits run out, we've seen people's savings is now down to the rate it was at 15 years ago. So savings are way down. Consumer spending is at consumer debt is up considerably over what it was when the pandemic started. So we've got more debt. We've got reduced savings, and now reduced or eliminated government benefits. So I think you're going to see work become more valuable and important once again as people need it to survive. So I think we'll see a change, but it's going to be a while in coming.
Yeah, I mean, it's interesting to me that the idea of the need to survive is going to be the ultimate incentive. That it's more about surviving rather than thriving, and I think it's this partially sort of a societal aspect as far as just in general, people not feeling like they have a chance to really move up the ladder because of wealth gaps and all these things that are often kind of referenced out there. If you look back at your career and how you've incentivized people to work for you and with you, how do you get people to realign their hopes against a future which increasingly for a lot of people makes them feel like their efforts not going to maybe change too much?
Well, I think this is a country and has been throughout my lifetime. When I come from a working class family and was able to, go to college, go to law school, and become a CEO of an international corporation. I mean, those opportunities are still out there. They're still available. People still have education opportunities, and they still have opportunities in the workforce. I would say don't believe a lot of what you hear, a lot of what you read about what your opportunities are. Go out there and find out for yourself. I think if you look back to the last 2 to 3 years of the under President Trump, and we saw the uh, the uh, the wealth gap, the income gap decreased significantly because more people got out there and worked. There was more opportunity to go out there and work. Those opportunities still exist today, and I'd say they exist very significantly because employers are looking for employees. So if you're hardworking and determined, you're going to go out there. You're probably going to find a pretty good paying job. You're probably going to find very good benefits. And if you're diligent and determined, you can, in fact, improve your life. I wouldn't listen to anybody that tells you that you can't. This is the country where you have every opportunity to do so. And if you decide that you don't have the opportunities or you don't want to take advantage of them, that's certainly your right. But they are out there, and I'm very disappointed to hear that people, in fact, believe there aren't opportunities because it's just not true.
Yeah, no, I think it's fair. I think, I mean, it's just there's something that I think that's pervasive underneath the subconscious of society where people just don't feel like they can have the same degree of opportunities as older generations have. I don't know if it's just something that often you see across time with generations, but it seems to be a louder and louder portion of the discourse. Now, part of incentives is a discussion around interest rates, which is the cost of capital, and I wonder if higher rates it maybe changes the incentive structure for corporations in terms of where they spend their capital now that it's not as cheap as it used to be. How do higher rates factor into this desire for companies to bring in talent and it's not just a function of higher rates result in unemployment, right? There's other dynamics in terms of how interest rates impact the labor force.
Yeah, I'd say first of all, just to get back to the opportunity point for a minute before moving on to interest rates, Like I said, there's 11 million jobs out there, and there's only 6 million people out there looking for jobs. So you are, if you're an employee, you are a very valued, highly sought after asset. And there are plenty of opportunities out there if you want to take them. Now, you're not going to go into a job, as the vice president of the company, or as a senior management official. You're going to have to go in and learn the job, learn the basics, and kind of move up the ladder. Of the opportunities are out there, and I don't. Interest rates are intended. The current interest rate increases are intended to reduce demand. In other words, we've got a supply. We've got a problem in the economy right now, which is that demand is grossly exceeding supply. Part of the problem with supply is that coming out of the pandemic, businesses didn't know how much to produce, and couldn't find employees. And now one of the big problems is that they still can't find employees. So that's holding supply down, and demand was grossly um, uh, incentivized because we had all of this government spending out there, and people had plenty of money to spend. They just weren't able to get goods. And when you got a lot of money and you don't have a lot of goods, the cost of those goods is going to go up as people are willing to pay more to get what they want. So interest rates are intended to drive down demand, which will eventually cause an increase in unemployment. There'll be fewer and fewer jobs out there as businesses create fewer and fewer jobs. But that really hasn't hit yet. At the moment, we're continuing to add significant amounts of jobs to the economy every month. And if you're looking for a job right now, you should be able to find one. But as businesses cut back, you've heard about Facebook cutting back a lot of tech jobs. That, of course, tech was bloated. The jobs were too high paying, and there were too many people working for companies to make those companies profitable long term. So you're hearing about Meta, you're hearing about Twitter cutting back on the number of employees, Google's cutting back, but there are still plenty of opportunities out there. But over time, higher interest rates intended to drive down inflation will impact unemployment, and that will make jobs harder to find.
Do you get the sense that the mainstream media often blames the government, whoever's in power, whoever's president, more than the Federal Reserve for why inflation's elevated? I mean, it's my own sense that yes, the stimulus checks obviously had a big impact on inflation, but nothing comes close to the sheer amount of dollars that the Federal Reserve pumped into the system. But it's almost like a here's the birdie, right? It's look at what the government's doing and how wrong it is. Meanwhile, it's ultimately about the money printer.
Yeah, and we did print a lot of money during the pandemic, but I think we needed to. We told people they couldn't go to work. We told businesses they couldn't open. So if we were going to, when the pandemic ended, if we were going to have any kind of economy, we needed to, during that period of time, pump money into the economy. The problem was that by January of 2021, uh, the pandemic had essentially the worst of the pandemic had passed. That ended. We had the vaccines. People were starting to go back to work. People were starting to feel more comfortable. People that were at risk, still should have stayed home and protected themselves. But those were basically people that were elderly or ill and probably wouldn't have been super involved in the workforce in high percentages in any event. So we started to come out of it. The problem was we knew coming out of the pandemic that people had a lot of money. Saving rates were very high, debt was very low. We knew people had a lot of money. And we knew that because businesses didn't know what to order or produce and didn't have the employees to produce it, even if they had known, that we didn't have a lot of supply. So we knew there was a lot of demand and that there was limited supply. So the one thing we shouldn't have done was to continue spending. And in March of 2021, the Biden administration, the Democrats and the Biden administration passed what they called the American Recovery Act, which it really poured kerosene on this inflation fire by pouring $1.9 trillion into the economy. And then they would pass what they called the Inflation Reduction Act, which would pump another $700 billion into the economy. Now, the problem really stemmed from early 2021, maybe late 2022, when the Federal Reserve should have recognized that we were going to have this problem coming out of the pandemic and that it wasn't temporary. You remember initially all the predictions out of the Federal Reserve was that this was a temporary problem, that inflation was transitory, it wouldn't last. And in fact, it wasn't transitory. And in fact, the spending that the Biden administration, the Democrats engaged in early 2021, it poured kerosene on that fire of demand. And this isn't, I'm not the only one that said this, nor was it just conservative economists. Larry Summers, who was the Clinton Secretary of the Treasury and also a head of the Council of Economic Advisors under President Biden, and was the president of Harvard University, warned that this would happen. Ed did Jason Furman and Steve Ratner, both of whom were Obama administration economists. So everybody kind of knew this, that we were in a very, very difficult situation, but the Biden administration and the Federal Reserve Bank ignored it. And they kept spending. The Fed didn't take any action to try and rein in the money supply or ease up on what's called quantitative easing, which involves the Fed buying bonds or buying real estate secured assets. They continued that even though it looked like we were going to have a major inflationary impact. And the Fed finally did realize that inflation wasn't transitory, but it really was too late to get the surge in inflation under control quickly, which they could have done in 2021. They waited too long. And now we're at the point where we're trying to drive the interest rate at least up to what the inflation rate is, and we'll probably end up in a balance of around a 5 to 6% interest rate, which would be very, very bad for the economy and will reduce the number of jobs. But I think that's altogether that's not an easy thing to understand, and I don't think the media gets it right. But I think they do get it right when they say that Fed did. Like, this Biden administration Fed policy is like a dog chasing its tail. You had the Biden administration continuing to spend even after the Fed started to increase interest rates to slow the economy down. So you had them fighting each other, but to get back to your original question, they both deserve some blame, and the Fed part is probably harder to understand, so it probably gets less attention.
No, and the two obviously need each other, right? I mean, you
Yes.
can't do quantitative easing unless you've got issuance of treasuries by the government for them to buy up. But I've made this point before, Andy. I mean, the real Inflation Reduction Act is austerity. The problem is you can't get elected via austerity. And let's face it, talk about being conservative from an economic standpoint, both Republicans and Democrats are pretty poor at managing the deficit. I mean, debt loads keep on increasing, no matter who's in power. How do you resolve that? Because I feel like this discussion around incentives for labor also relates to incentives by those who control the purse strings and what they do with our taxpayer dollars.
Yeah, I'd say, really, if you look at this, it's really a two-part problem, and anybody who took high school economics should easily understand this. Is we've got a supply and demand problem, and there are when supply and demand are basically equal, when they're right across, when they're flat, or a little bit off, you end up with very low inflation. You end up with the Fed's target of about 2% inflation. So if demand is really high and supply is really low, there's two things you can do. One is you can decrease demand, which is painful. I mean, that's where you stop people from spending, and it really hurts the working and the middle class. So when you drive up interest rates, when you reduce jobs, when you make things more expensive, it really hurts the middle and working classes. And so driving demand down is one way to attack inflation. You just drive it down to supply. The other way to fight inflation, which is what Ronald Reagan did, while the Fed is trying to decrease demand, is to increase the supply of goods. So if we have an increased supply of goods, then supply can meet demand, and inflation will dissipate. Now, increasing supply doesn't hurt anybody. Increasing supply is actually good for the entire economy. It's good for jobs. It's good for American families. But the Biden administration and the Democrats attack what they call supply side economics as trickle down economics. There's nothing trickle down about it. The more the supply of goods increases, the less goods cost. And you can see this in particular with energy right now. We see a real decrease in the amount of oil that's available because of Biden energy policies, which he came out and said in the campaign that he was going to destroy the fossil fuel sector, and he's worked diligently to try and accomplish that goal. Now, he knows that the problem is the supply of oil, which is why he releases oil from the Strategic Energy Reserve, but in an effort to drive the price of oil down by increasing the supply. But we could increase the supply by reducing regulation on on the oil industry, on the fuel sector, and by making it putting things like the Keystone Pipeline in that make it cheaper to transport oil, that would increase the amount of oil, and that would reduce inflation because energy impacts the cost of everything. Everything you own, everything you buy has to be delivered someplace, and that all involves transportation costs. When you heat your home or cool it, that's obviously involves energy, obviously involves fossil fuels. I think there's 3 to 3.5 billion people in the world who depend on synthetic fertilizers to feed themselves, and that depends on the availability of natural gas. So you've really got a ton of things that depend on having a thriving energy sector, and the Biden administration has been working diligently to, at least in the United States, wipe out our energy sector. So you find that these policies matter. These policies head us in either in a positive or a negative direction, and we're because of the policies that we've been dealing with since 2021, we're seeing things go in a very negative direction.
And part of that supply side discussion relates to competition, right? You need to have more and new companies entering various industries to create new products to bring down the price of things, so you don't have this kind of situation which I think we're in, which is that most industries are largely oligopolies, which is why there's so much pricing power. And you often hear that term, Andy. You want to have a government that's quote unquote business friendly. And I think most people equate that to taxation. But from your experience as somebody who ran a big company, what makes for a business friendly environment, and what kind of policies should be enacted by both sides to make it more business friendly, to bring in more competition, to lower prices?
Well, you know what, you framed that question very well. The taxes are obviously important because the more profit a business takes out of its business, the more it can reinvest in the business, the more it can pay its employees, the more it can get done, the more it can pay its investors. But the other part is we do have this tendency to go towards these large companies running things, these large monopolistic companies. And part of that problem is government regulation because you've got, for example, with the Dodd-Frank bill, which is a bill that came in to regulate the banking sector, it's very, very difficult to comply with the regulations that have been acted under Dodd-Frank. What that meant is that a lot of community banks just went out of business because the only banks that could survive, the only banks that could afford the cost of complying with government regulation, were in fact the large banks. So while this bill was intended to wipe out the notion of a bank is too big to fail, we're going to solve that problem. What they ended up doing was wiping out the community banks and making the banks that were already too big to fail even bigger. And this happens in various sectors. For example, right now, if you're in the energy sector, if you're if you're an independent trying to open up a new oil field or natural gas fields, try and drill to get more energy out, you've got to get permits, you've got to get leases, you've got to go through hoops that are just almost insurmountable unless you have an incredible amount of cash. Which is why you see these large oil companies getting bigger and bigger, and the independent, the more competitive companies having a more difficult time to survive. So, and keep in mind, regulation is a tax. When people have to comply with regulations, when businesses have to comply with regulations, it increases their cost of doing business, and that gets passed on to consumers. And people say, well, that's not fair. Why would they pass the cost on to consumers? Well, the reason is that if you get to the point where your costs exceed your ability to profit, you go out of business. And so the only way these businesses survive is by absorbing the cost of government regulation or absorbing the cost of increased taxes and passing those on to consumers. So a business friendly environment to me is always lower taxes, less regulation. I think President Trump had a rule that for every new regulation, each agency had to wipe out two existing regulations, and I think they either ended up they were very aggressive about it, and they ended up wiping out 6 to 8 regulations for every new regulation. And prior to the pandemic, we found one of the strongest economies, one of the strongest labor markets, one of the best markets for Americans of both sexes and of every race, doing extremely well. Record low unemployment rates for blacks, for Hispanics, for Asians, and and median family income hitting new highs, income inequality declining, all because we rationally enacted more friendly economic policies, and we saw a lot of new business creation because of it. So reduce regulation, reduce taxes, focus on domestic energy production, and you will have a productive and business-friendly economy.
All right, so let's transition that now to the name of the space, which is ESG is socialism in disguise. You've done a full discussion around this topic. A lot of these Twitter spaces end up having quite a bit of frustration around the ESG movement. A lot of people will, I think, correctly blame the energy mess on the push for ESG. I want you to talk through to the audience what are some of the problems you've identified when it comes to ESG and why it's not really exactly what you want to see in a capitalist society.
Well, if you're an American and you're making and you have assets to invest, whether you're involved in a pension fund or a 401k plan, or you're just a young person working on trying to build up a nest egg, you can no longer invest as we did in the past. You can no longer conduct business as usual. You can't invest as usual. You can't even donate to charities really as usual, because the radical left now controls the investment firms that we all once trusted, because we believed they would invest our money as prudent investors, not as political activists, and certainly not as leftist crusaders. But according to one set of data, about 74% of the companies in the S&P 500 today, so the largest American companies, are engaged in some form of left-leaning political or social activism unassociated with their duty to shareholders, profits, or returns. And though it's socialism in sheep's clothing, because it really is an effort to empower a group of financial elites, people that run these large investment firms such as BlackRock, State Street, and Vanguard. You hear a lot of BlackRock in the press. You hear a lot about BlackRock and their CEO, Larry Fink, in the press, but Vanguard and State Street are right up there with him. And what this ESG investing, which stands for environmental, social, and governance directed investing, is really an attack not only on capitalism, it's an attack on our founding principles. It's an attack on our democracy, our economic freedom, and our individual liberty. It's an attack on our democracy because the asset managers who control large numbers of shares that they don't own, they vote them in shareholders meetings, but they're actually owned by people that are beneficiaries of pension funds and 401k plans. But they use the power they get to vote those shares to as a shortcut around the ballot box, a shortcut around the democratic process to advance these leftist agenda items that just aren't popular. Like getting to net zero carbon emissions, or discriminatorily putting people on boards of directors, or putting in critical race theory HR policies at various companies. You end up with a company like Disney that's now just a total mess because it's been pressured to implement these policies without any legislative requirement do they do it. This wasn't something that our representative democracy passed. It was something that these large asset managers forced down Disney's throat. And it's a threat to our economic freedom because these large asset managers use their power to force the CEOs of American companies to implement these policies, not only to implement the policies, but to put implementation of those policies above their responsibility to generate returns for investors. So you invest with somebody to get returns. You invest with somebody so that they will increase the value of the money that you've given them or give you some income off of that money. And their focus becomes not doing that for you, but getting these leftist agenda items to advance those leftist agenda items, and they put your consideration second. And it's a threat to our individual liberty because they promote these leftist agenda items with our money. It's not like they're using their money to promote these items. If they want to use their money, that's fine. The problem is they use the money of pension beneficiaries and others to advance their political agenda, which again empowers this group of social elites to use the private sector as a tool, again, to avoid the inconvenience they find in our representative democracy and in our free market economy. And they do this by, again, attacking the profit motive. The idea that you can improve your life through your own efforts. They attack that motive. They don't want corporations focused on returns for investors, on profits. They want these corporations focused on advancing these social political items, and that's wrong. That's just a misdirection, and will have a very negative impact on our free market economy and on our prosperity.
When did this really start, Andy? Because I feel like it's been building gradually, and it kind of all came to a head, only recently.
If you go back to who wrote Rules for Radicals, Saul Alinsky. If you go back to Saul Alinsky's book, Rules for Radicals, he actually talks about this. Now, nobody took it seriously at the time because nobody thought you could ever get CEOs not to focus on the profitability of their companies. But that's when it started. He kind of mentioned it back then. And then you had something developed called index investing, where people like BlackRock, State Street, and Vanguard, they don't go out and do an analysis of a company and say, well, you should invest in this company and not in that company. Index investing involves sectors. So like the S&P 500, which is an index, is the 500 largest companies in America. It's an index that you can invest in. And when you invest in a product that's based on the S&P 500 index, you get a little small interest in 500 companies. Now, the idea being those 500 companies being the largest in America, they ought to do pretty well. I mean, that's the thought. And therefore, you might have one or two losers, but you think the management teams are doing pretty well. We'll invest in these 500 companies and we should get a good return. And in fact, that turns out to be true. Now, there are other indexes. There are energy indexes, tech indexes. You can invest in a variety of indexes, but they're not focused on individual companies. They're focused on sectors. So companies like BlackRock that are now looking at an index as opposed to every individual company don't get focused on making sure that a particular company has a good management team doing the right thing. They now take these large voting blocks and can vote them in favor of issues like carbon neutrality by 2050, which is a big issue for BlackRock that they say will require a transformation of the entire economy. Well, none of us voted for BlackRock to transform the entire economy or to come around with a net carbon rule by 2050. So you see that they've really changed their emphasis, and they really realized they had this power. I think in around 2015, 2016, we really started to see a surge in the way these large asset managers voted their funds, and it was really a surprise, I think, to a lot of people. It was a surprise to me when I figured it out a couple of years ago what was actually going on. But I would say it's a long answer to your short question, but I think it probably started around 2015, maybe earlier than that. There was some minor influence, but I think the real powerful influence started around 2015. I'm not sure. I know there was a lot. There was a lot in that question. So first of all, private equity firms are different than large asset managers. With a private equity firm, you choose to invest in a private equity firm, and if you can invest in and that private equity has been generating very, very good returns, because generally private equity firms don't follow the ESG model. Generally, private equity firms are very, very focused on investor returns because they only survive if there are investor returns. They're managing other people's money, but they're judged by their productivity with respect to that money. The problem comes in with these large asset managers who invest in index funds, and you're right. Switching from a model that focuses on indexes as opposed to being focused on individual companies, you are going to miss some good investment opportunities. But you're also going to miss some bad investment opportunities because with stock pickers, you get people that pick good stocks and you get people that pick bad stocks. And hopefully over time, they pick good ones more times than they pick bad ones. With the index is designed to reduce risk. So if you've got to use the S&P, because it's the most common index, as an example again, when you invest in 500 stocks, your risk is significantly lower than when you're investing in a stock here and a stock there. You've really got the potential to benefit from, say, 490 stocks or 350 stocks performing well, and maybe 250 or a smaller number not performing as well. So you really kind of reduce your risk, and with a pension fund in particular, and pension funds have billions, if not trillions, of assets invested at this point, both state and private pension funds. Uh, with a pension fund, your goal is simply is to get a return, the best return that you can, a reasonable return, but not to take extreme risks because you're investing on behalf of beneficiaries of the fund. Now, I think this doesn't mean that you shouldn't invest in. If you think there's a solar panel company that's a good investment, well, you should invest in it. But you should invest in it because you think it's going to be a profitable solar panel company. If you think the solar panel industry is going to be profitable, it's good to invest in the solar panel industry because you think it'll be profitable. I think that's a good investment. And if you're a fiduciary like BlackRock, State Street, and Vanguard, investing other people's monies, that should be your objective. You're objecting to advance the interests of your beneficiaries. You're not investing there. You don't invest other people's money to change the world. You invest other people's money to generate a return for those people. And if there are any progressive economists listening in on this, I'm going to tell you a very simple rule that you can go by when you're investing. And that is that companies focused on profits will be more profitable than companies that aren't. Now, everybody expects me to say something else after that, but that's really kind of it. I mean, I can tell you as a former CEO of a large international corporation, it's hard enough to make a profit when you focus on it, let alone when you're focused on trying to change the world consistent with some progressive leftist agenda. If you're investing other people's money, your sole duty under the fiduciary duty rules, not only of ERISA, which is a federal law, but of the fiduciary duty laws in every state, if you're investing other people's money, your sole focus has to be generating returns for those investors. So that's the most important objective in all of this, no matter what you're doing. If you're investing other people's money, you're investing your own funds. You can invest to change the world. You can invest, for whatever purpose you think you want to invest for. But the problem is these large firms investing other people's money, not their own money.
Aside from energy, which I think is the sector which most people will point to as being the one that most impacted by the ESG push, what other industries and sectors do you think ESG has had a more meaningful negative impact on than most people realize?
Well, there's part of take ESG. So you talked about the environmental part. Let's go to the social part, which is a lot of companies are being compelled to put in these critical race theory HR policies, where you teach your employees basically that they're either oppressors or oppressed based upon the color of their skin or their nationality or some other cultural factor or racial factor, rather than who they are as a person and what they've done as a person. I think you're basically, in that case, you're teaching your employees to hate each other. And it makes very little sense to teach your employees to hate each other. I mean, we ought to be all, as a CEO, former CEO of a company, it was important for me to teach my employees that we were all part of a team and that we were working together and that nobody had an advantage based upon their race or their sex or their religion or their political affiliations. We were all working towards one objective, and that was to have a successful company through which all of us and our investors and our customers could benefit. So I think there's that problem. And Coca-Cola ran into this problem back in, I think it was April of 2021, when you may recall, there was the Georgia voting law, which turned out to actually be a law under which more people voted than had ever voted. And Coca-Cola came out against it, and they also implemented critical race theory HR policies. And there was a poll done after all of that became public, saying that about 37% of Americans were saying they were less likely to buy Coke products because of this. Well, I would have liked to have been at that board of directors meeting where the CEO tried to explain that because of these policies they were losing business. But they quickly changed the policies, and the person who had put them in place was invited to leave the firm, and in fact did leave, although he was a capitalist when it came to himself, and he got a very good departing bonus. But that's an example of the social part. The other part, governance, again, we can go with diversity, where the requirement under the governance portion of ESG investing is that you put people on your board of directors not based on their qualifications, their merit, or their character, or how they could benefit the business, but based upon their race or their sex. And again, I personally find that offensive, and I think Martin Luther King would have found it offensive. He was the one who said that he looked forward to the day when his children would be judged by the quality of the character, not the color of their skin. And if we're trying to get to a society again where people are judged based on the color of their skin, this governance part of the ESG investment criteria is the way to go, because that requires basically that's how you judge people. In fact, Nasdaq is making that a rule, that you have to have a certain diversified number of people on your board of directors, which also assumes that people of a particular race or sex all think the same, because you want to get this diverse input, but people of different races and sexes, they don't all think the same as the other people of that race or that sex, and so it's really a faulty premise to begin with. So if you look at Disney's a very good example of how a company can get completely screwed up trying to abide by these ESG criteria, and is now heading down a very negative path economically, and its stock is way down. Netflix was being pushed down that path, and actually the CEO of that company came out and informed the employees of the company that they were no longer going to be listening to absurd demands from employees. They were going to be listening to what their consumers and their customers wanted, and to the best of their ability within the limits of the law and cultural acceptance, they were going to offer what their customers wanted. So it impacts a lot more than people think. The main focus is always on the environmental requirements, the net carbon requirements, the destruction of the fossil fuel sector, but there's much more to it.
Let's go back to a point you brought up earlier. You allude to this idea that government really doesn't understand how the job market works and understand how job creation works. Somebody sent me a DM saying, "Well, what about if we're talking about incentives and the government's role in providing incentives? What about just skipping the idea altogether of trying to change an attitude and just bring in people with better attitudes? Primarily through immigration policy." Because if you're an immigrant and you were in another country, you're not used to that kind of stimulus. You're used to being a hard worker. I'm curious to hear your thoughts on the role of immigration when it comes to labor incentives and the idea of working harder and competing against others around you.
Well, look, you can't, you can't deny the importance of immigration. Immigration's been critical throughout our history as a nation, and even if you look around at look at Elon Musk as an immigrant. I mean, these immigrants always rise to the top. They work very hard. They're very appreciative of what they have in America, and I think many other people aren't. They sit around, being discouraged by lack of opportunity because they can't go right into a company and become an executive. Immigrants understand that just having the opportunity to do the work and to move yourself up the ladder of opportunity is important. So I think that's important. Now, I have to say, it should be legal immigration. We can't just allow people in the country willy-nilly. We can't just open our borders and let anybody in. As we're seeing now, we're having these incredible problems at the southern border with cartels and human trafficking, and people bringing in fentanyl and other narcotics. We've got to have a border, or we're not a country. But legal immigration is extremely important, and I think is something that has been important throughout our history and will continue to be important going forward. It's also a way that we can address declining population or reduction in the rate of population growth, so it's important. It's important in a number of ways, and I'm a big proponent of immigration, but again, legal immigration. We shouldn't have open borders.
That's fair. I think everybody can please make sure you follow Andy Puzder here on Twitter. What would you do if you were if you had the position in place in government? What would you do to set the conditions up for a more thoughtful and harder working labor force? How do you realign incentives from expecting stimulus to getting more out of more work?
Well, really, American businesses don't need stimulus to grow. I mean, your objective is to grow, and I think the less the government has to do with picking winners and losers in the government, and the less it has to do with trying to decide the direction of the economy, the better we do. That really, it's socialism where the elites come in and say, well, we're going to have BlackBerry phones instead of iPhones, or we're going to where they try and make choices that really should be left to consumers, to what Adam Smith called the invisible hand, which is consumers directing the economy in the appropriate direction without interference from government elites or from corporate elites. And really, that's been the system that's driven incredible prosperity in the United States. In fact, Barack Obama, back in 2015, speaking at Georgetown University, on the economy said, we don't dispute that the free market capitalism has created more wealth than any system in history and has lifted billions of people out of poverty. Well, why do you want to mess with that system? I mean, this is an incredible system that's lifted billions of people out of poverty. It's created wealth that's affected everybody that's listening to this call. It affected your parents, your grandparents, your great grandparents. We've had 2 years of the most incredible economic growth in the history of humankind. And when government gets more involved, when we go back to what we had prior to 240 years ago, which is every country being run by some form of dictatorship, either a monarchy or another form of dictatorial government, we're going to get back to that where elites are making these kinds of decisions. We're going to end up back where we were economically, which is back in 1820. I'll give you an interesting figure from the World Bank. Back in 1820, we had 94% of people in the world were living in extreme poverty. And of that 6% that were living in extreme poverty, probably 3 or 4% were just living in regular old poverty. As of just before the pandemic, that number was down under 10%. It's down to about 8% of people in the world are living in extreme poverty, and that's all due to our free market economic system, which is spread across the globe. We've had particular growth in reductions in the poverty rate since the Soviet Union collapsed in the early 1990s, and since China adopted what they call red capitalism. It's really ought to be called revised socialism, but at least has a little bit of capitalism involved, and that's really lifted a lot of people out of poverty in that country. So it's important that the government not be overly involved, and in fact, that's not to say we need a court system, we need contract law, we need criminal law, we need a civil safe society. We need government regulation to protect oppression and to avoid monopolies. It's not that government doesn't have a role, but it seems that the government's role continues to grow and to grow and to grow past the point at which it's productive for society. And I think we've reached that point, and the pandemic has just almost really accelerated the growth of government and the government's influence in our lives. And we need to get back to a point where that's not as pervasive.
Yeah, no, and I share that mindset. I don't know how you how you really do that. I mean, there's so much entrenchment, so much money in the system, so many people in power that don't want to lose power that it's hard to imagine any strong hand forcing a smaller government. I mean, you can only really have a smaller government if you stop spending and increasing the debt load. And again, I go back to both Republicans and Democrats seem to be pretty good at just increasing our leverage.
Yeah, President Reagan said that government never gets smaller voluntarily. And so it's either going to happen through our democratic process. We're actually going to elect people who will rationally deal with the economic issues we're facing. And that means people are going to have to step back and say, look, this may benefit me personally, but I'm going to have to vote against the person that's supporting this policy because it's not going to be good for the country. We can't keep doing this. It's either going to happen through the democratic process or we're going to have another economic crisis. And it's going to force this country, and if it forces this country, it'll force countries across the globe to revise their economic policies and deal more rationally with what's going on. You may recall just before the pandemic, and even early in the pandemic, there was this theory that the progressive left was pushing called modern monetary theory. I like to call it the magic money tree theory, which was that government could print money and spend forever and things would never get worse. And initially, AOC was Alexandria Ocasio-Cortez was out there saying that, well, the early pandemic spending proves that modern monetary theory, it works and government can just keep spending. Well, I think we've now discovered that that's not the case, as we see inflation soaring at 40-year highs, and we're facing the potential of not only a recession but stagflation and potentially a depression if we don't change our economic policy. So we will learn from this. The question is, will we learn fast enough to save ourselves, or it's going to take longer? Than this election that just occurred last Tuesday is an indication to me that things are going to have to get a whole lot worse, which is tragic because I was concerned going into the election with how much worse could they get, but apparently they're going to have to get a whole lot worse before people actually decide they want change.
Yeah, no, I'm with you on that. Okay, I think that's maybe a good place to end this Twitter space. Again, everybody, please make sure you follow Andy Puzder. If you're curious, check out his books on Amazon. Getting America Back to Work is shared in the nest here. And again, I will have this as an edited podcast. Andy, real pleasure listening to you. Appreciate you spending the time with us here, and everybody enjoy the rest of your day. Thank you, Andy.
Thanks, Michael. Pleasure to be here.
Cheers.